gold as an investment sucks. I told that last guy, that young man before the break, get rid of his gold, don't buy gold. Okay? The average annual rate of return on gold is about 1% over the last 70, 80 years. Over the last 5 years, it is broke even. If you go back before that, it was the high when everybody was scared to death that the economy was going to crash. A bunch of people put gold. It was $2,200 an ounce. Now it's $1,400 an ounce. You would have lost 34% since then. So that's what gold's done for you. Oh, by the way, during the 5 years that gold broke even, the S&P's up 34%, 33%, meaning the stock market. And so had you invested in good mutual funds instead of in gold, you would have actually made some money in the last 5 years. And so this is what you need to check on. This is what you need to understand. Do not put money in a commodity. Commodity is an item. We don't buy corn futures. We don't buy gemstones. We don't buy silver. We don't buy gold. These are commodities. We don't buy any kind of agricultural futures. And the reason is that the item has a set amount of supply and demand, and the only thing, or a set amount of supply, and the only thing that drives the price on it is one of two things: fear or greed. You cannot predict whether somebody is going to be scared enough to move all their money over into gold and drive gold prices up, or greedy enough to move all their money out of gold and drive gold prices down. You can't predict human nature and what it's going to do. What you can do is do math on assets that make money. An asset that makes money is not a commodity. By making money, I mean it literally produces money. A company a share of stock is sold in, you can actually look at the profits of the company. You can actually look at things the company owns. You can look at growth trends in the profits and the balance sheets of the companies. Profit to earnings ratios, PE ratios. You can look and do a financial analysis on this stock and thereby place a value that has a mathematical reason for the value on that share of stock. On a group of stocks, it's called a mutual fund. And the values are derived as a mathematical process. 1 + 1 = 2, not, oh God, I'm so scared I'm going to buy gold. That's, a guy with bad teeth that was on TV 25 years ago following the Snuggie commercial and the walk-in bathtub commercial on cable news is trying to sell you gold. Right beside a reverse mortgage. This is where you buy your investments, right next to Snuggies and walk-in bathtubs. That's not a clue. That is a clue. Don't do it. Okay, so stay away from gold. It has a horrible rate of return. Stay away from commodities of any kind. I buy things that have a mathematical, predictable thereby rate of return. I can actually forecast based on what it's done in the past. Past returns are not guarantees of future returns. Well, no, they're not guarantees, but they are indicative. It's the only forecasting method that there really is. And if there's zero past returns, you don't know what the flip you're buying into. That's why a company going on the stock market, initial public offering, an IPO for the first time is so difficult to value. Because you get information about what the company used to make when it was private, and it's supposed to be documented, but it's all about staging that stock price. And so IPOs are just dangerous. I like to buy things that are predictable. When I buy a piece of real estate, I don't buy the real estate based on anything except the money that it makes. It makes this much rent, and that is an X return on the amount of investment I've made. And that's what you're looking for, is a return on investment. So this is why you don't do that.